Welcome to this explainer. So, have you ever stared at a financial chart and just thought, wow, this is a total chaotic blur of green and red lines? Like, it just looks like a completely random string of numbers dancing up and down, right? Well, what if I told you that market volatility actually isn't just random noise? It's really not. It's a deeply structured visual language of human psychology, just waiting to be decoded. Literally, every single day, buyers and sellers are leaving a permanent record of their fear, their greed, and their indecision. And today, we're going to learn how to read that record. We are going to translate that language together.
But to truly understand this language, we kind of have to go back in time. There was this fascinating 2011 Bloomberg report that highlighted how this charting method actually has ancient Japanese roots. It was originally developed by rice merchants centuries ago just to track price momentum. The core philosophy behind this technique is pretty profound: enlightenment through realized knowledge. So it's not simply about plugging data into some complex math formula. No, it's about keenly observing the raw emotion of the market participants and then using that realized knowledge to illuminate what might happen next.
So, here's our roadmap for today's explainer. First, market enlightenment. Then we'll look at single session patterns, move into 2-session patterns, step it up to 3-session patterns, and finally we'll wrap up with the final frame.
All right, let's jump right into section 1, single session patterns, the alphabet.
Okay, so these individual daily trading lines, they are absolutely the foundational building blocks of market sentiment. It's kind of like the alphabet of our language. Just by analyzing the shape of a single session, where the price opened, where it closed, how high or low it pushed during the day, we can uncover a massive amount of information about who is actually in control, the buyers or the sellers. Let's start with the hammer. As the name suggests, it literally looks like a mallet. This is a very specific bullish reversal pattern, and you'll find it at the bottom of a downtrend. The defining rule here is that the lower shadow, that long thin line pointing downward, has to be at least twice the length of the real body sitting right up at the top. Psychologically, this means sellers really tried to push the price down heavily during the session, but buyers stepped in with just incredible momentum to offset that decline. They effectively hammered out a bottom. The fear that drove the market down, it's suddenly being replaced by aggressive, confident buying.
Now, let's flip that and contrast the hammer with its bearish counterpart. This is the shooting star, or nagareboshi in Japanese. Imagine you're watching a really solid market uptrend, and suddenly, bam, this formation appears. It symbolizes trouble overhead. Notice how the criteria totally mirror the hammer, but in reverse. The shadow is still at least twice the length of the small real body, but this time that long shadow is pointing up, with the body at the very bottom. What this tells us is that buyers aggressively tried to push the price higher to continue that euphoric rally, but that upside was fiercely, firmly rejected by an overwhelming wave of sellers. The momentum shifts abruptly. It's a huge warning sign for traders that the upward force is exhausted, and all that greed is very quickly turning into caution.
Moving on to section 2, 2-session patterns, the words.
So if those single lines were our alphabet, these 2-session patterns are our words. This is where adjacent periods interact to tell a much deeper, more nuanced story of that constant battle between bulls and bears. By comparing today's candle directly with yesterday's, we can actually spot critical turning points. Take the harami pattern, for example. The word harami translates to pregnant in Japanese. And looking at the shape, you can see exactly why. You've got this dominant, large mother candle from the first session that entirely contains, or gives birth to, a much smaller candle in the second session. Now, you can have a bearish harami at the top of an uptrend or a bullish harami at the bottom of a downtrend, but in both cases, the signal is exactly the same. The dominant force in the market is losing its power. That massive directional push from the previous day is completely exhausted. The market is hesitating, which is a major signal of a potential imminent reversal in direction.
Next up for our 2-session words is the piercing line, or kirikomi. And guys, this one is a highly dramatic bullish reversal. Let's break down the criteria. First, you have a long, bearish candle right at the end of a downtrend. The sellers are clearly running the show. Then, the very next session, the price actually gaps lower at the open, meaning it opens significantly below where it closed yesterday. Naturally, this initially entices even more sellers into the market because they're thinking, wow, the crash is accelerating. But then, and here's the twist, a massive positive reversal happens. Buyers surge back into the market, pushing the price all the way up to close within the top 50% of the previous day's real body. Just try to imagine the psychology of a short seller in that exact scenario. They thought they had the upper hand with that huge gap down, but by the closing bell, The rug has been pulled completely out from under them, and they are left entirely questioning their positions. Now, just as we saw with our single patterns, every bullish formation has a bearish twin. So, meet the dark cloud cover, or caboose. This is a bearish reversal that pops up in an uptrend, and it's literally the exact psychological mirror image of the piercing line. First, you have a long bullish candle. Then it's followed by a session that gaps higher at the open. This creates absolute euphoria for the buyers. The market feels totally unstoppable. But before the end of trading, a severe negative reversal takes hold. The price drops and closes deep within the lower 50% of that prior bullish session's real body. So that initial optimistic surge is completely wiped out, inviting waiting short sellers to aggressively jump in and drive the trend downwards. It literally brings a dark cloud over all that previous optimism.
Which brings us to section 3. 3 session patterns, the sentences. We're now stepping up into the most complex category of our visual dictionary. Because these require us 3 full periods to form, they naturally take more time and data to develop. They often function as complete thoughts, frequently confirming a trend's continuation rather than just signaling a sudden reversal. Let's walk through the specific criteria of one of the really fascinating 3-step formations, the Tsuki gap continuation. Let's look at a bullish example here. It requires a sudden gap up in price. Following this gap, you'll see 2 subsequent candles, one bullish and one bearish, preferably pretty similar in size. But the absolutely crucial part of this 3-step dance is that the final candle opens inside the previous one's body, and then it closes below it, essentially filling that initial gap. Visually and psychologically, what this implies is a brief, much-needed pause. It's just a round of standard profit-taking by those initial buyers. Actually, it's a very healthy correction. And once that's out of the way, the market has caught its breath, and the original trend is fully primed to resume its upward trajectory with totally renewed strength. And finally, section 4, the final frame, psychology or prophecy. So, over the last few minutes, we've built a highly structured visual dictionary, moving logically from the simple letters of single sessions all the way up to the complex sentences of 3-session continuations. But as students of the market, we really have to remain neutral and objective. These patterns are brilliant, completely time-tested theories of market psychology. But I want to leave you with one final question to think deeply about. Are candlestick charts a true, organic reflection of underlying human psychology, actually capturing the raw, unfiltered fear and greed of millions of independent actors? Or, because so many modern traders are trained to look at and react to these exact same patterns, do they merely create a self-fulfilling prophecy in the financial markets? It's a huge debate, and it continues to this very day. I highly invite you to take the visual dictionary we've built today, pull up some of your own charts, and just try to read the story the market is telling you. Thank you so much for joining me on this explainer, and definitely keep learning.